I threw it into Nvidia. If we really zoom out, and think realistically, like Nvidia is July and August, like it really had a hard time getting above 177. And we just pulled right back to that price. It just feels like it's drastic because of the rally we've had this year,
Mm-hmm.
Yeah, and I was noticing that on a few of those companies, like they've all pulled back to monthly levels where whether it was like a monthly breakout level or just the previous month's opening. I was noticing that on a few different stocks. But we're gonna get into it. There's a lot to cover.
A lot to cover, a lot to get into.
Where let me just read the full disclaimer. Full disclaimer: our content is presented to be used and must be used for informational purposes only. It's important to do your own research before making any investment decisions based on your own personal circumstances, and you should take independent financial advice from a professional or independently research and verify anything that you hear in our club. Um, Before we get started, let's just check the temperature of the chat. Like, how are you guys really feeling? That's what I want to know. We've had a roller coaster of a week, but I also think today alone was a roller coaster in itself. How are we feeling?
We got told we may not get rate cuts, and then we get told today we may get rate cuts. It's just like, what is going on?
Nobody knows what's going on. Like, just the day before, the odds were like 30-something percent, 40-something percent, and now I saw today it jumped up to like 75% possibly, or 66 to 75 or something like that. Yes.
That's why I don't even pay attention to that stuff. Like that one bit, like the whole poly market odds.
Oh yeah, no, that
or any of that. But you guys can be honest with how you feel in the chat, because this is a safe space. We want everyone to be able to feel optimistic. Like who just said that? Feel optimistic, like Marcus said, and like this is a place to learn. Like we were here in this spot back in April, and we're going to be in this spot sometime again in the future, in the upcoming months, or maybe in the next year. Like we don't know the exact date, but the markets always pull back, and like how Ian says, and Troy and Rashad, like the market is permanently rigged to go up. Like if we're being honest, we're in the never-ending bull cycle, which is pullbacks and corrections along the way, and like getting great entries is important.
Yeah. But I think it's also important, like Ian said something, and he said something these last couple of Mondays. He's been saying that if you're feeling like anxiety or freaking out about what's going on in your portfolio now, you may have entered too high. And it ends up being the retail investor's journey, where the media starts flooding headlines. Think about who owns these headlines, and they start flooding the news. What's going on with this stock? Everybody starts, retail investors like hype, but the stock has reached a level of resistance. And what we saw was the stocks kept running, and they had been running for, steady into November, right? People are thinking like, oh, now we're about to hit this major bull run. But a couple of things had happened. The VIX had broken out of a key area of resistance. The S&P 500 got really close to 7,000, which was the initial first target that I was starting to hear for analysts this year was 7,000 for ES. And we got really close to that number. We approached a lot of resistance levels with trend lines, but the market started to pull back. But if we think about it, isn't that healthy price action? Don't we want price action? If we just have steady price up, we should actually be scared of stocks like that, because what goes up must come down, right? And how will that drop feel? But I think that if anything, this recent drop, I hope that you guys take this seriously, because the only way to really grow an account is to have a strategy, not what someone else's strategy is. Like when Troy says, somebody's asking, should I sell? He's like, well, what was your plan before you got in? That plan is something that's formed before you get into that stock, having that strategy, having that plan, knowing how much of your brokerage account is going into options, knowing what it means to be over leveraged when you have way too many options trades open for the size of your account. All of those things, if you're experiencing a loss with this recent pullback, start thinking about different strategies for next time, because there's a lot of lessons in this pullback. I know for me, I took a loss with CoreWeave. CoreWeave, once it hit 134, I knew it was extended, and I knew some of my contracts didn't have enough time to survive a pullback. I took profit because I was up like 30%. I got out of some, but I was like, I'm going to leave runners like I was going to feel okay about that loss. I'm not okay with that loss. I'm actually like really disappointed that I held past my rules, but it's a lesson. There's so many lessons. When I sit down and really think about everything I learned through CoreWeave, it's like, you know what? That's a $3,500 lesson. I'll eat that. I'll eat that because I'm paying my tuition to the market, right? Mm-hmm. But we want to learn to survive. We want to play the long game in the market, you guys. So something I really want to, I'm definitely planning to cook tonight. Troy requested some stocks, and I also promised you guys some stocks I wanted to look at, being Meta and Microsoft. But I want to leave you guys with, and I've recommended this in the past, but Mark Douglas, if you look it up on YouTube, I'm going to post this after our class. I'm going to post it in the community. Mark Douglas, his stock trading psychology seminar, Thinking Like a Pro Trader, that I listen to that at least once a month. I'm listening to him because when I start to feel greedy, I started to take profit and I felt stupid because the market kept running. And then because I let that, and I thought I was like, cool. I'm cool. I'm not entering. But then as soon as the market pulled back, I started to enter the market without that real sign that, and I was like, wait a minute. I thought that I didn't let the run mess with my psychology, but I did. I did develop a bias because I was just waiting for that first pullback to enter, and I took a loss. But Mark Douglas, I plan to listen to it this weekend. I think that it's really good for anybody that's dealing with the market, especially with options trades. That risk management is what keeps you in this game in the long run.
Yeah. Somebody pointed out Trading in the Zone as well. That's a good one as well. Yeah, definitely.
Yeah, that's his book. It's Trading in the Zone by Mark Douglas. Yeah. But on YouTube, there's a whole it's probably like 6 different. It's like a 6-part class series that he has, and he's just talking about risk management and discipline in trading.
Mm-hmm. I've listened to those before too. The thing I want to point out, what Steph said, is how she goes back and listens to it. Just because you listen to something one time doesn't mean that has to be the only time you listen to it. Only time you pay attention to it. You learn something new every single time you listen to something, and then it hits you differently. Like something that I do a bunch is run back some of Ian's Trading in the Dark. I'm Trading After Dark. I mean, on YouTube, and I run that back every couple of weeks. To be honest, just to be able to make sure I'm staying in the mindset with futures, make sure I'm staying in the mindset with trading and charting and everything along those lines. And I learn something new every single time I listen to it. And I'm sure Steph could say the same about the Mark Douglas YouTube episodes.
Yeah, because we have to be honest. This is a psychological thing more than anything else, because y'all cannot tell me that at some point in time, them contracts were not green. Like a lot of contracts, Oracle, from when Troy called it to when Oracle hit its high, Oracle went almost mine went up 200%. So, and then there is research out there. We put videos out for you guys talking about where those stocks are at. So there are tools out there for you guys, but just make sure that you're using them, studying before drops like these happens. That way, when these drops do happen, you feel better prepared, and you actually feel excited because you had cash, because you were like, you know what, I didn't catch the very top, but I took a lot of my profit out because I knew I was up crazy. Maybe I left some runners, but I knew what my risk tolerance was. I left some cash behind. Now this drop may feel like an opportunity to those people that were patient. And that's a different feeling. But that also comes from experience and living through moments like this of overholding, of not taking profit the first time. Because when you take profit, when you have a rule that you say, I'm going to take profit 100%, you look stupid to the person that waits till they're at 400%, right? Until that person was waiting for 400% and held down to their negative 30%. We know them contracts will do that to you.
Life comes at you fast.
So yeah, just work on that strategy before times like this, because you'll be more prepared when this moment happens.
Yeah, and I would say one thing that's helped me out is literally just thinking about this moment, like April. What did I feel during April? Everybody was panicking just like this. The market was extreme fear. But literally a month right after that, all those strong companies rebounded. So I think this is a great opportunity to, while we're in this moment, to sit here and look at those companies like, oh, wait, these companies are resilient. What levels are they at? Is this a good area to get in at? And like we just mentioned, we have a bunch of videos going over how we're able to dissect that and make some sound decisions. So, when moments like this happen, I understand the chaos because all the headlines and everything, but we've been here before. We're going to keep saying that every time this happens, that we've been here before. You just have to remember to like you said, it's psychological. Just remind yourself, like, oh no, this happened a couple months ago. Let me calm down. What happened this time? And then make your decision after that. But yeah, let's get into it.
Yeah, let's get into it.
Let's go. Let's cook. So, let me share my screen with you guys. My apologies. All right, here we go. So let's do it. Crypto bear market. So I've been seeing a lot online, a lot on social media, and it's interesting to me how everybody wishes and hopes for Bitcoin in the 80s and 90s when it's at $120,000, but when it's actually in the 80,000s, nobody wants it, and everyone's yelling that this is the bear market. The 4-year cycle is over. We're entering a bull year in 2026. But if you guys have been paying attention to everything I'm presenting, I've told you that this cycle will be different, and we're going to get into exactly why today. So let's start off with just emotions. Now, this is a document that I shared in the EYL community today. But for those who didn't see my post, I'm going to reread it for everyone today. Embrace market declines. Emotions and investing don't mix. Emotional investors tend to sell when the market is going down and buy when the market is going up. They should be doing the opposite. As shown below, if you only own the U.S. stock market on the day after up days since SPY began trading in 1993, your cumulative gain would be just 44%. If you only own the market on the day after down days, you'd be up 851%. That's very telling. Like, market pullbacks are our friend. Like, yes, in the options world it's different, but I'm strictly speaking from a long-term perspective, because every single investment we make on the long-term side of things should be a 5-10 year hold minimum. I know people want God candles, and I know people want all-time highs over and over and over again, and we all deserve to take profits in the crypto realm and in the stock market side of things as well. But truth be told, institutions don't care about when we want to take profits. They're on their own timeline, and that's something that we're witnessing right now. This is a quote from Charlie Munger. If you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you are going to get. And this isn't meant to be harsh to anybody, or make anyone feel bad for not being okay with a 50% drawdown 2 or 3 times a century, or whenever it may happen. This is to show you that these drawdowns do happen. And if you look at this chart right here, we drew down 51%, but this return and run up from the 2008 timeframe is insane. And this will happen again. It may not happen today, it may not happen tomorrow, but it will happen again. And pullbacks like these last couple of weeks, this should be training you to be mentally more prepared and for these pullbacks in the future. So let's talk about Bitcoin's 4-year cycle. Everyone wanted to say that the 4-year cycle is the same over and over and over again. As I've told you guys before, the 4-year cycle is changing. This is a document from Bitwise. The first cycle was the Bitcoin cycle, as they call it. The second cycle was the Ethereum cycle. The third cycle was an early application cycle. And now what we're going through right now is a multi-year bull run. We're living through the mainstream cycle. Everyone wants to say that crypto, the Bitcoin will have a major down year next year. But everyone wants to say that this is going to be the best year returning in 2025, when that's not what happened. If you guys look at Bitcoin's chart, year to date, we're actually down. So the 4-year cycle is over. We're not repeating the same things over and over again. And we're going to go through a couple of reasons why today, why I'm a true believer in the 4-year cycle being done. And one's institutional adoption. We've never once had regulations across the globe, not only in the United States, but in every single major economy worldwide. Every single financial provider worldwide, from Visa, from MasterCard to SWIFT, from PayPal, from Cash App to the Bank of International Settlements, from Wise to MoneyGram to the Federal Reserve to the Bank of Japan to the Bank of Canada, you name it, from BlackRock, from JP Morgan, they are all adopting this technology right now. And they're not going to stop buying these assets just because of some made up 4-year cycle that was the thing of the past. Another reason why the 4-year cycle is going to be over with is because of crypto ETFs, and we'll get into that later on. But I was reading something that I think he is the CIO or CEO of CIO of Bitwise. He said that he's been having meetings with institutional clients, and he just presented to 1,500 institutional clients a couple of days ago, and not one of them brought up price. They all brought up use cases. They all brought up where we are right now today and how can they gain access to this industry. Institutions don't care about the price. And if we're really being honest, right before we get the crypto market structure bill, which is a full regulatory clarity for the crypto market inside the United States, I'm not surprised the market pulled back because institutions want the best buying prices available. Let's move forward. So for those of you guys who follow what I post in the EYL community, this is one of my favorite on-chain data things to be able to track for Bitcoin. This is the trend accumulation score by cohort. If you guys want to be able to see this chart, go to Glassnode. You can follow them on Twitter or X or anything along those lines. And you can see these updated scores. This is from 11/17. So when it's dark red up here, well, first, this is cohorts by Bitcoin holding. So the top one is whales with over 10K Bitcoin, then 1K to 10K, then 100 Bitcoin to 1,000, so on and so forth. If you see blue, that means heavy, or dark blue, that means heavy accumulation. Dark red is heavy selling. Right now, they just stopped selling. This is from 4 days ago. Bitcoin whales are starting to be in the neutral area, while other people are heavily accumulating. There's no surprise to me why we had this sell-off, because Bitcoin whales were not accumulating since mid-August. They were selling from mid-August to early November, and now they're hitting a point of seller exhaustion. And that's something that I've seen multiple times in documentations. And some documents, I'm not going to say that I am, but some documents are calling for the bottom in crypto right now, mainly because of seller exhaustion. And this document kind of points towards it, with whales not selling as much as they are. So let's talk about bull market drawdowns. The intensity of market corrections during bull markets has declined during the 2023 to 2025 uptrend. What people don't know, if you guys haven't been in the crypto market for multiple cycles, like this 40-30% correction is brand new to you. But for those of us who have been around, this is not anything new. And to be honest, the pullback that we have now isn't even the largest pullback of this bull market. We had a larger pullback earlier this bull cycle that was 32% in Bitcoin. And I think we're hovering around 30% right now. In 2020, in the middle of a bull market, we had a 63% drawdown. 2017, we had a 36% drawdown. 2013, we had a 71% drawdown. And Bitcoin still was able to touch all-time highs after that. Bull market corrections and drawdowns are normal in this asset class. Just because we draw down 20-30% doesn't mean the world's crashing down. Institutional adoption is happening. And there's actually a site, I can look up the name of it later, but it can track how much Bitcoin or how much of these assets such as Bitcoin, XRP, Solana, HBAR do these institutions own within the ETFs. And right now, institutions have bought up 6% of the Bitcoin supply. Do you think that institutions are going to stop buying Bitcoin over the next 3 years just because of some crypto 4-year cycle that's everyone just agreed on? No, they're going to continue to buy it, and with a finite supply and demand is going to play effect. So this is a document from November 18th, 2025. Now, measuring day 43 returns is arbitrary. And we are not implying that the ongoing drawdown is poised to repeat the lasting bear cycles of 2018 and 2022. We are opposed to the idea of the 4-year cycle repeating and view the recent price action as a major deviation from the underlying fundamentals of Bitcoin. We repeat our view that institutional adoption from banks, asset managers, pension funds, and financial advisors is a net positive factor ahead. We believe clear regulation will accelerate this trend and that expansionary monetary policies will reattract attention towards scarcity once structural derivatives headwinds are fully resolved. Excuse me. Now, this is a document from Bitwise. At the same time, on-chain profit taking remains elevated at around $620 million per day, but is beginning to moderate, suggesting that the pace of investor de-risking is showing the first signs of exhaustion. And this matters. Like once, at some point, sellers are going to just stop selling, and then inflows are going to come again. And if you guys want to see why the Bitcoin price is dropping, look at the Bitcoin ETF inflows and outflows. When there's heavy outflows, the Bitcoin price drops. When there's heavy inflows, the Bitcoin price goes up. And ironically, we've recently had ETF approvals for Solana, XRP, and HBAR. And all those are seeing record inflows. I think there's been 1 day of outflows, and that was for the HBAR ETF. Solana has yet to see a day of outflows. XRP has yet to see a day of outflows. And HBAR has only had 1 day of outflows out of 7 days. And meanwhile, Bitcoin is seeing record outflows. It's just, to me, they're just selling the Bitcoin ETF and putting it into these other ETFs. Therefore, while this period is stressful, the data suggests we are in a necessary market cleansing phase, often associated with discovery of a local bottom. This intense pain for short-term holders is a recurrent mechanism that flushes out weak hands and transfers assets to patient, long-term believers at lower prices. It's a painful but vital reset that strengthens the market's foundation. The wave of panic selling may be nearing exhaustion. This is the second document that says the same thing. The wave of panic selling may be nearing exhaustion, potentially setting the stage for a more stable and sustainable recovery built on stronger conviction. And correct me if I'm wrong, this is the third document to say the same thing, because this document, the trend accumulation score, you see seller exhaustion right here. This document from Bitwise, the first signs of exhaustion. This document from Crypto Quant, exhaustion. When you see multiple things being repeated across documentation, across institutional documentation, that's something we have to look out for. And the reason why I personally focus on institutional documentation is because people are paid to do this. These institutions, they hire research analysts where the full-time job is to research and to look at on-chain data. So if someone's paid to do the work, I find who the best is at that, and I follow what they say. In general, we think the fears of a cycle top are overblown due to the following reasons. This is a document from Bitwise as well. Bitcoin valuation is now signal an undervaluation of Bitcoin. This is why we continue to regard the current market environment as an attractive opportunity to increase rather than decrease exposure to Bitcoin and other major crypto assets. We rather regard the current drawdown as an interim bull market correction rather than a drawdown into an ensuring bear market. So let's talk about why I feel as though that the 4-year cycle is done, and some of the reasonings behind it is because of crypto ETF launches. Now, specifically some of these altcoin ETF launches. Out of, I think there was, 900 or something ridiculous number of ETF launches this year. You want to know who the top 3 ETF launches of 2025 were? 3 altcoin ETFs, 2 being XRP and 1 being Solana. Day 1 volumes for XRP ETF was $59 million. The day 1 volume for Solana ETF was $57 million. And then after the top 3, it drops down to, I think, $20 million at the next highest, or roughly. That's a large gap. And for day 1 volume, this is institutional buyers. This is not retail pouring in $50 million or $57 million on day 1. This is not retail having, think Solana's at 19 consecutive days of $1 million inflows. This is institutions. And for altcoin ETFs to be able to have the top launches of 2025 quietly is very telling. And I know some people are going to say, like, why is the price dropping if institutions are buying the ETFs? Because for those of you who don't know, when someone buys a physical ETF, when someone buys the ETF, that issuer has to buy XRP and Solana off the exchanges. But why is it dropping? If you guys go to ChatGPT, or even you want to go to TradingView or CoinMarketCap or whatever you chart Bitcoin on, look at the date where Bitcoin ETF got approved and look at the price action immediately following. I'm not surprised that XRP and Solana are following the same route. But the thing that makes these two interesting is the supply dynamic, because Solana doesn't have a finite supply, but XRP has a finite supply. There's only so much that can be bought. And both of these are having more and more issuers release new ETFs. Solana had an ETF come out from Fidelity the other day. That's one of the major banks in the world or in America. XRP has the ETFs, 2 ETFs that are coming out next week from Franklin Templeton, 21 Shares, and Wisdom Tree. Those are some pretty big names as well. These are going to attract millions and millions of dollars of inflows over the course of the next couple of weeks. And at some point, the supply and demand aspect will hit, and seller exhaustion will hit as well. So let's talk about some of the Solana ETFs. Now, we have Van Eck, which is a major player in the financial ecosystem. They release a Solana ETF. You have 21 Shares, Solana ETF. You have Fidelity with a Solana ETF, and you have Canary with a Solana ETF. For those of you guys who don't know, ETF issuers wouldn't come out with an ETF if they thought they were going to lose money. If they thought that this cycle was over with, they wouldn't be releasing altcoin ETFs right now. They're in the game of making money. If they're in the game of making money and they have confidence in these assets, and these are some of the largest financial institutions in the world, we have to have confidence in these assets as well. XRP's record day one trading volumes. Despite the past regulatory scrutiny regarding its legal status, XRP follows Solana closely, with the SEC approving its first spot ETF applications in late 2025. This action shows growing regulatory comfort with tokens that have achieved significant market maturity and liquidity. A notable early launch with Canary for Capital XRP ETF, launched in 2025, posted 250 million first day inflows, demonstrating immense pent-up demand. The approval of XRP ETF alongside Solana establishes a clear path for other altcoins that have faced regulatory ambiguity but possesses deep market liquidity. So let's look at who else is releasing XRP ETFs. You have Bitwise that came out a couple of days ago. You have 21 Shares, which is coming out on Monday. You have Wisdom Tree coming out in the next couple of weeks. You have Grayscale coming out soon. You have CoinShares. You have ProShares. You have Volatility, MEMX, and then you have Franklin Templeton, which is, I'm pretty sure, coming out on this upcoming Monday. Why else do I think that we're not entering some bear market territory that everyone believes? Because BlackRock filed for an Ethereum staked ETF the other day. Some people may or may not know this. BlackRock's not going to enter something where they think they're going to lose money, where they think that crypto's entering this bear market. Larry Fink is on the record multiple times saying we're going to tokenize every single financial instrument. And he even said that most countries, most governments, they are not prepared for this. But guess what? We are. We have to find solace in these documents. We have to find solace and comfort in the research. When the world's all complaining, and when the world and Instagram and Twitter and social media and these new sites are saying that everything's over with, we have to lean on what got us here, and that is the documentation and the research. Because me personally, I've been deep into the documents for almost a decade now, and at this point, like, if any of you guys went through my photo album, I guarantee you would not be bearish. If you saw some of the documents I have sitting in my phone, you would not be bearish. You would be sitting here and be like, oh my God, I need to accumulate as much, and this is not financial advice, but I need to accumulate as much as I possibly can before the next 5, 6, 7 years. This is a generational buying opportunity before regulations, before the market structure bill, before the ISO 2022 deadline, which comes tomorrow. So we're going to go through a couple announcements that happened these past couple weeks, or past couple days, to be honest, that people may have missed. Visa just announced a partnership with WireX and Stellar XLM. Our dual stablecoin settlement system using USDC and EURC on the Stellar blockchain is now officially live and fully integrated with Visa. I'll repeat that. Is now officially live and fully integrated with Visa. I know DeHuda was cooking last night talking about Visa, and Visa is one of my favorite companies right now. It's because I know what they're doing with the stablecoin space. For those of you guys who are confused why USDC is on the Stellar blockchain and partner with Visa, let's break it down for you. USDC is a stablecoin. USDC does not have its own blockchain, and that's something that's is a hindrance on USDC, and that's why companies like Ripple and RLUSD, their stablecoin, is superior because they have their own blockchain. They don't have to outsource it. But USDC, they have to outsource their stablecoin on top of other blockchains for it to function. So who did they choose to outsource their United States dollar stablecoin and their euro? They chose Stellar, and now they're partnering with Visa. How it works behind the scenes. When you make a purchase with your WireX card, the settlement step where funds move between WireX and Visa now takes place directly on chain using USDC or EURC. This capability is powered by WireX Pay or on-chain stablecoin infrastructure that connects self-custody whilst to real-time card and banking payments. The result is a seamless blend of blockchain efficiency, stablecoin programmability, and Visa's acceptance network. This means that you'll never know that this is happening behind the scenes. You're just going to tap your Visa, you're going to tap your MasterCard, and you're going to just realize your money's getting there faster. And you may not even realize your money getting there faster. But behind the scene, companies like Visa and MasterCard, they're going to be saving billions and billions of dollars selling on the blockchain because it's faster, it's cheaper, and it's more efficient. And institutions, like I've said before, they don't adopt things for fun. They adopt things because it's faster, cheaper, and more efficient. So what's something that's going on right now that a lot of people probably don't know about, because people just automatically assume that because we got the Genius Act, banks are full steam ahead adopting stablecoins. No, there's other global regulatory frameworks that have to be adjusted. Like how I told you guys before, it's not just the United States, it's not just Canada, it's not just the EU, it's not just Mexico. It's all of them coming together at the same point in time, the same point in history, and adopting stablecoins, adopting blockchain technology, and that's what's happening today. The Bank of International Settlements, before I read this document, is the bank of central banks. What they say, people normally listen to. But they came out with a framework that was proposed in 2021 by the Basel Committee. Who's the Basel Committee? The Basel Committee is the global standard setter for bank prudential regulation, was set to come in force at the start of this next year on January 1, 2026. The widespread growth of stablecoins this year has led to calls for a rethink. The committee operates under the jurisdiction of the Bank of International Settlements, an organization owned by many of the world's central banks. The explosive rise of stablecoins has triggered pressure from U.S. banks and regulators on the Basel Committee to reconsider its stringent capital requirements for crypto assets. So if you guys have ever heard of Basel III from these institutions or from people speaking about it on the news or something you may have read, this crypto is directly affected within Basel III. Banks and institutions holding crypto is directly affected by Basel III. And the United States and the EU both said we're not adopting this because of the stringent regulatory processes. Despite being marketed at lower risk digital currencies, stablecoins remain subject to the same harsh regulatory treatment as volatile cryptocurrencies under current Basel rules. The existing regulations mandate that banks maintain substantial capital reserves against potential crypto losses. Following resistance from the US and UK to adopt these standards, the stablecoin surge has intensified demands for reform. The Swedish central bank governor added that stablecoin boom and the growing market presence necessitate a fresh regulatory perspective. So you not only have the US, the UK, Sweden, and Japan all saying no. So what is the stringent rules? Why are they saying no to this? Why is this having to be adjusted so banks can hold crypto and stablecoins on their balance sheet? The Basel Committee currently imposes a 1,250% risk weight on bank holdings of unbacked crypto assets such as Bitcoin, Ethereum, classifying them among the most hazardous assets under global banking standards. These regulations, finalized 3 years ago, are scheduled to take effect on January 1. Under this framework, banks must reserve $1.25 in capital for every dollar of crypto they hold, rendering direct crypto engagement financially unfeasible for most financial institutions. Consequently, banks have avoided holding or providing loans against these assets, keeping crypto largely off institutional balance sheets. This harsh approach, initially intended as a protective measure, is now being reassessed as stablecoins' use expands and major economies pursue divergent regulatory paths. So, why is this important? This is literally telling us that some of the major financial players around the world, they want to be able to hold crypto on the balance sheet. They want to be able to hold stable coins on the balance sheet. Remember what I told you guys, a stable coin, they need to operate on the blockchain. Think about stable coin like the train, blockchain like the train tracks. They can only move with gas. That gas is the gas fees. And we'll get to gas fees in shortly and what just happened in the United States a couple of days ago that probably went underneath the radar for a lot of you. But the gas fees is how we make our money. They have to pay a fee to be able to operate on the system. But these institutions wouldn't be telling the Basel Committee no, or wouldn't be telling the Bank of International Settlements like we can't adopt this if they did not want to hold crypto on their balance sheet. Point blank simple. So for some of the largest countries around the world saying we can't do this because our banks and institutions want to hold crypto and want to hold stable coins, we have to rewrite these rules is massive. All of this is happening at the same time. We have to look at the global picture, not just the United States picture. This regulatory snapshot underscores a core truth. Firms need to design tokenized products that are both adaptable and jurisdictional aware, while global frameworks remain uneven. The overall trajectory is shifting from resistance to readiness, especially as major regulators begin clarifying how blockchain can coexist with traditional financial laws. So, what did the OCC say? And if you do not know who the OCC is, type in real quick on ChatGPT. It's very important for banks in our country. The OCC confirms bank authority to hold certain crypto assets as principal for purposes of paying crypto asset network fees. Remember what I just told you guys. Stablecoins are train, blockchains are train tracks, and to be able to move, you need gas. And that gas is basically the network fees. The OCC published a letter confirming that national banks may pay network fees, sometimes referred as gas fees, on blockchain networks to facilitate otherwise permissible activities and hold as principal amounts of crypto assets on balance sheets necessary to pay network fees for which the bank anticipates a reasonably foreseeable need. The OCC also confirms that national bank may hold amounts of crypto assets as principal necessary for testing otherwise permissible crypto asset related platforms. This is massive. This came out November 18th, 2025. During this whole drawdown while people are calling for a bear market, the OCC quietly released this to all the banks in the United States. The acting chair of the FDIC is preparing for this is another document talking about something else now. So you not only have BlackRock ETFs, BlackRock having Ethereum ETFs, you not only have the Basel III requirements being changed for banks, you not only have the OCC telling banks they can hold crypto to be able to pay gas fees. This is from the FDIC. The acting chair of the FDIC is preparing new guidance for tokenized deposits and expects to introduce an application process for stablecoin issuers by the end of 2025. That's massive. Interest in real-world asset tokenization has surged across Wall Street and global regulators this year. Excluding stablecoins, the value of tokenized real-world assets topped $24 billion in the first half of 2025, driven largely by tokenized private credit and U.S. Treasuries. BlackRock has been one of the most aggressive adopters. I'll reread that. BlackRock has been one of the most aggressive adopters, launching its tokenized money market fund, BUIDL, in 2024, which quickly became a dominant product in the real-world asset sector. If BlackRock does something, they are bullish on it. They wouldn't be adopting this, applying for Ethereum ETFs if they thought they were going to lose money. So, what's going on with the market structure bill and crypto legislation? Because we got the stablecoin bill a couple months ago, and we will be getting a market structure bill sometime in 2026. The reason why it got pushed back is because of the government shutdown. Senate Banking Committee Chair Tim Scott dropped some long-awaited clarity on Tuesday morning when he revealed a tentative timeline for advancing crypto market structure reform in the Senate. By the end of this year, next month, we believe we can mark up and vote in both committees and get this to the floor of the Senate early next year, so President Trump will sign the legislation making America the crypto capital of the world. As the Senate is working on its own version of the Clarity Act, the Clarity Act will return to the House for final approval if it's passed by the Senate. So, why is this important? Because, as some of you may know, the House passed the market structure bill. It went to the Senate. The Senate changed some things within that bill. So now once the Senate passes it, it has to go back to the House for a vote. and then it goes to President Trump. So I wanted to bring this up for some of you guys who will be following this closely, so you're not confused when this bill goes back to the House after the Senate passes it. So this document is a document that I will share. I'll share tomorrow in the group. It was a pretty interesting document. It surveyed more than 1,000 respondents from 43 countries. At the bottom part is where I'm reading. More than 1,000 respondents from 43 countries took part in the survey, with an average of more than 10 years of investment experience. The reason why I'm sharing this is because this is outside the United States. Once again, we have to focus on the global picture. The sample is weighted towards Europe and Asia, with strong participation from Switzerland, from Germany, the UK, France, Italy, Singapore, and Hong Kong. And this was about HNWI's high net worth individuals, or high net worth investors. Q4 allocations were delayed due to market uncertainty. In late Q3, Q4 allocations were planned on anticipated catalysts, including more ETFs and market structure bills. These have not yet arrived. They have now, since the document came out. And Q4 to date has been marked by adverse market conditions, including the October liquidations. Some plans may have changed. Mid Q4 sentiment may also be influenced by anticipating cooling momentum after the impact of market catalysts not yet in place and uncertainty about 2026. This here on the right says actively managed and passive market exposure led investment strategies. Single token exposure is no longer the dominant strategy. I've shared this before. Bitcoin only, Solana only, Ethereum only, XRP only, whatever you're a maxi of. If some of you are maxi, it is not a realistic stance. Institutions are not doing that. I've shared documents from institutions in the United States, from Canada, from Mexico, from Japan, and now from this plethora amount of countries that I just read earlier. And they all are saying the same thing. Single token exposure is no longer the dominant strategy. And how do we know what else to invest in outside of just Bitcoin? The tokens that are being adopted the most. I've talked about all of them on here. Ethereum, Solana, XRP, HBAR, XLM, XEC, Quant, Algo, IOTA, Chainlink, etc., and so forth and so on. What percentage of your portfolio is currently allocated to crypto assets? And this is the same survey. 48% of portfolios are allocated more than 10%. They wouldn't be allocated more than 10% if they were bullish. It's that simple. So look at this. So we have 10% is allocated more than 50%. We have 15% is allocated between 20 and 50%. 22% is allocated between 10 and 20%. So on and so forth. At some point, we all have to be invested and allocated to this space. I don't care if it's 1%. I don't care if it's 5%. I don't care if it's 50%. I'm not telling you to do either or, but the returns are undeniable over a long period of time. What are your future plans, future crypto allocation plans? 61% of respondents are crypto plan to increase their exposure to crypto. Interviewed more than 1,000 banks, 1,000 institutions all around the world, outside the United States, and more than half plan to increase their allocation. Why do you plan to increase or maintain your crypto asset allocation? Expectation of higher future returns. Expectations of higher returns are leading the reason to increase allocations. Many investors show conviction that several demand catalysts should carry the market further into the new year. And that wording is key. Further into the new year. This document came out maybe a couple weeks ago. They're talking about into 2026. Do you plan to make a crypto asset allocation? This is for those with no crypto asset allocation. 36% of the people without a crypto allocation plan to allocate to crypto, and 44% of them remain undecided. That's new money flowing into the space. That's not old money. That's not money that's already been there. What are your primary reasons for not investing in crypto assets? Regulatory uncertainty is the number one reason. So once we get the market structure bill, the number one reason goes away. What best describes your crypto asset investment strategy? Single token strategies are still sizable at 38%, concentrated heavily on layer one tokens such as Bitcoin and Ethereum, with supply demand imbalances, corporate demand, and staking could act as a catalyst for future upside potential. And this is important because BlackRock just applied for a staking Ethereum ETF, and this document is saying that staking could be a future catalyst for Bitcoin and Ethereum. Beyond Bitcoin and Ethereum, are you interested in other crypto ETFs? 81% said yes. And that is why I showed you the documents regarding the Solana and XRP ETFs being the top 3 inflows of 2025 for ETFs out of all of them. All the stocks, whatever ETF people wanted to make, Solana and XRP were number 1 and 2. So let's give a quick recap on switching gears. Let's talk about ISO 20022 for a couple minutes, and then I'll pass it off to Stefan DeHuda. I know I've been going on a long time thus far, but I wanted to make sure that you guys saw all the documentation that I thought was necessary to be able to ease some of you guys' fears about bear markets, about exiting your position and trying to enter in at a lower place, because we won't return to the prices that we had last year. We won't return to the prices we had in 2023, 2024. And I hope the documents I showed you today was able to show that. But tomorrow's ISO 20022 adoption for SWIFT globally. Every bank, every country, every institution, they have to adopt ISO 20022 starting tomorrow. It's massive. On November 22nd, November 2025, on 22nd November 2025, the global payment network SWIFT will end support for the legacy message format for many cross-border payments, requiring the newer ISO 20022 standard instead. ISO 20022 is a universal standard for financial messaging designed to streamline electronic data between institutions. Over 70% of financial institutions, including SWIFT, FedNow, which is the Federal Reserve, and major banks like HSBC and JP Morgan, will adopt ISO 20022. For cryptocurrency, ISO 20022 compliance ensures seamless integration with legacy financial institutions, unlocking institutional adoption and cross-border utility. ISO 20022 assets are XRP, XLM, HBAR, XRC, Quant, and Algo. They're gaining traction with central banks, with 82% of SWIFT transactions expected to integrate ISO standards by 2026. SWIFT handles messaging and payments for 11,000 banks globally. 82% of that will be going to ISO standard and dealing with these tokens. These assets remain among our top picks, given the support by enterprise partners and major institutions, as well as the real-world use cases in payments and tokenized finance. We believe we are at the front of major adoption wave. The likes of BlackRock, Fidelity, JP Morgan, and many other institutional giants are currently stacking up on these assets, while simultaneously getting the best price after scaring retail investors out. I'll reread that for you guys. The likes of BlackRock, Fidelity, JP Morgan, and many other institutional giants are currently stacking up on these assets while simultaneously getting the best price after scaring retail investors out. Skip that one. The clock is ticking on the ISO 20022 deadline. November 2025 marks the end of the coexistence. The deadline will fundamentally alter the operational requirements of participation in the global payment system. ISO 20022 is not just a compliance exercise. It's a once-in-a-generation opportunity to rewire the global payments for richer data, greater resilience, and innovation at scale. So what do some of the ISO 20022 tokens do? Screenshot this. XRP handles cross-border payments. XAC handles trade finance with shipment and shipping container trade globally. Then you have compliance reporting, is what Quant and Algorand do. And you have banking automation, which is what Stellar and XRP does. So I hope that was able to it's not letting me get rid of that. There we go.
Gotcha.
Thank you. Appreciate you. But I hope that was able to help you guys. I hope that was able to ease some of you guys' fears. The crypto market that we're entering into over the next couple of years. That was me, my bad, dude.
No, you get it. You get it.
But the crypto market we're entering over these next couple of years will not be the crypto market that we're all used to. Things are changing. If the 4-year cycle was true, like everyone wants to say it is, Bitcoin would be up 40-50% right now, not down 5-10%. Point blank simple. Like we have different catalysts, there's different players entering the ecosystem that haven't been here before. And we have to be able to pay that homage and pay that respect. If when it goes up, if you want to take profits, great, but beg you, do not sell your whole bag. Hold for the next 5-6 years and you will be happy.
Yeah, appreciate that presentation. Fire as always. Um,
Austin, Davida asked, is it better to purchase the crypto assets directly and hold on a crypto wallet or purchase the crypto ETF?
Whichever one you feel more comfortable with. Now, me personally, I like the crypto assets directly, so I can hold them. But if you want the ETF, go ahead. Just know that you're paying fees to have that ETF. Whatever their exchange ratios are. Some of them are more expensive than others.
yeah. As for me personally, I also am all for directly owning the asset. And what I see a lot of people talk about is just being sovereign investors, because like they may not, a lot of, especially in our community, we don't have that trust with institutions because of history, et cetera, et cetera. And with this whole crypto revolution, those who are aware of that may feel more comfortable just owning it directly rather than relying on an institution to hold it for them. So it's really preference based. Like, do you feel comfortable with paying those fees and having an institution have your holdings, or would you rather take the accountability and make sure like you hold on to your seed phrases, make sure you have backups and have a close family member who has that in case something happens to you? It's all preference based. But definitely cold wallets for me personally over hot wallets because it's definitely more secure.
And look, like I know it's hard when you see on social media every single time. Every time I open my app for Instagram or X, it's crypto's crashing, the stock market's crashing. I know that's hard psychologically, but this is the time, like I said, like this is why these meetings are so important. This is why the technicals with Steph and DeHuda and the fundamentals and the research for me is like beyond important, because like we have to find comfort in this and help us, and this could help us guide these types of uncertainty to be able to build long lasting wealth.
Yeah. And just to go back and touch on what you mentioned about the fees, I did make a post in the community about how fees can affect your portfolio over a period of time of investing. So when you go into the community and check the forums under the investors group, there's a nice little visual that shows you how much that investment may be eating away, how much percentage that investment may be eating away at your net return. So that might be something to take a look at if you're still considering owning an ETF over just directly owning the asset.
I don't want to hold this up any longer. I know Steph's got to cook with the charts. I'm excited to see what levels we're sitting at. Someone let her do her thing.
Let's go.
Let's get into it, y'all. Alrighty. All right, guys. So I want to get started with ES. I want to take a look at the S&P 500, just kind of navigate where we're at. I want to show you guys something I've seen on the VIX, and then we're going to pull up a few stocks. Austin took his time, so I feel like I can take mine. And, we're just cooking tonight. It's Friday night. So, where else can we be, right? Where else can we be that's better than here looking at seeing and watching what our money's doing? So, all right, so I have on the right-hand side, I have a monthly chart pulled up for ES, and I have the same ticker ES. I have it here on the left on the weekly chart. So I just kind of want to show you guys a couple of different things that I see just from the higher time frame. First, I'd like to point out these trends. One of my favorite things to use when it comes to technical analysis, I like to draw out my trend lines. Not everybody does. They'll say, okay, we're in an uptrend, but I find that when I draw out my trend lines, I find those areas to act as support and resistance more times than not. Even like these same trend lines that I drew on the monthly, what I'll do to confirm them is I'll just come to a lower time frame and see how it reacted. So those same trend lines that I drew on the monthly time frame, you can see on the weekly that they give me more evidence that they're solid trend lines, because see how here rejected, it acted as resistance. Again, here in this area, and this lower one, how we acted as support here. See support. This was that April drop where we temporarily lost. We lost a 50 EMA here, and they dropped us to the 200 EMA, but we recovered this trend line. And so when we started to approach the top of this trend line, here's where we started to experience some resistance. We didn't even get as high as here. The top of this trend line looks like it's around 7,300. So we've been consolidating right around, right in this area between like 6,500 and 60 and about 7,000. We touched 6,944, the highest in October before pulling back. So, okay, so from here, let's draw out some levels. So I have this uptrend so you guys can see, right? From just zooming out, you see that we've been in this uptrend started since 2022, right? Was when we've built a base here near this bottom, double bottom, and we started this uptrend, and we've been creating higher highs and higher lows, right, in this uptrend. Anytime that we've pulled back to the bottom of this trend line, it's usually acted as support. Here in April, we temporarily lost it. But this area here where the 50 EMA is at is the bottom of this trend line. I'm not saying we're going there, but I'm just saying, you know, we're still holding pretty much in the middle of this trend line. We're still cooking into some type of uptrend, but the stock market doesn't just move in one straight line, right? It's a mix of buyers and sellers in the market. That's why especially when it comes to options, I think that entry really does matter. Technicals really do matter because and it's one thing to buy shares and say, hey, I'm holding for 10 years on dollar cost averaging and this thing has time to cook. But it's another thing to buy in a contract that expires, right? And that decays when it has has a lot of volatility or strong drops like we've recently seen. So that's why I always encourage you guys. And a lot of those beginner posts that we've had recently, we've been talking a lot about trying to buy stocks near support and not resistance, right? Because your probability is way higher when you're buying at support. So let's take a look at and see, let's try to draw out some levels and find some support and resistance levels here from our monthly chart to start off with. All right, so my monthly levels are usually in red. If you guys have seen me chart. So I'm going to draw, this is October's open. I'm sorry, October's close. So for the month of November, until I can get above October's open, I know that I'm still stuck in this pullback, right? So if for the month of November, I'm watching to see, you know, this is that level. 68.75 is what tells us if we're continuing or if we're still coming deeper to pullback, all right? So a few more levels that I'll mark here. I'm going to also mark October's open. You'll see how we recently reacted to that level. And from October's open, the next level, this candlestick here, the bottom of this is September's open. All right. And under September's open, I drew another level here. You guys can see here in July, this level acted as some type of resistance, but in September, sellers dropped the S&P back to the 63, that same 63.72 level to find buyers, and we're able to bounce here. But from here, also, we have the 9 EMA sitting on the monthly. And if you take a look at just the monthly chart for the S&P, you guys see how closely we follow the 9 EMA. And, you know, anytime that we've even lost the 9 EMA, we've usually recovered around the 21 EMA. But anytime we get too far, see when we were top of this trend line from the 9 EMA, we tend to gravitate back towards it. You know, typically we found support at that area. We've wicked a few times here, but even back here at the end of 2024, we were pretty far from that 9 EMA. And when we dropped, even in April, you know, they took us back down in March to that 9 EMA, and we see where we started to try to lose this bottom trend line, touch the 50 EMA, and they wicked us right back up. But they still respected the bottom of this trend line, even created a Morningstar pattern, which is a bullish pattern, especially off a monthly time frame. That's super bullish. And that brought us out all the way to around 69.53. So for us to complain that the market is pulling back after a move like this, when they brought us all the way in April to 4,800 and the market touched almost 7,000 since April, that's in less than a year. I mean, you know, we have to keep in perspective the move that market has done, right? And so for us to continue to hold at these highs, that was a choice that we made. You know, a lot of us probably said, you know, like, I can withstand, I bought time, and that's a strategy. You know, everybody has a different strategy. That is a strategy. But even with buying time, like with the pullback, what did you plan? What was your plan before you entered that stock? Did you plan to average in, right? Because now that the stock has pulled back, are you reaching areas of support that maybe you can average in, or was your plan to cut the trade? You know, like these things, everybody likes to enter the stock when we hear the bull market and all of these stocks are moving up, and it's fun, right? Because you think like, hey, I'm jumping on this train, I'm not missing out. FOMO, it's really easy for FOMO to kick in, especially in these areas, right, where we're at highs. Like if we started hearing the headlines, the NVIDIA partnership here and there, and it's like that system, your rules. What do your rules tell you? And if you didn't have them, now's a great time to form them. What did breaking your rules, maybe what were some good rules maybe you should have had? Maybe some things that you could use are, okay, like we talked about the RSI. Well, when we were reaching this 68.75 area, and I'm going to zoom out to the lower time frames, but when we started to reach that 68.75 area, something that I like to do is, even with talking about the RSIs, I like to start checking my RSI on my lower time frames, right? So like my daily RSI being this extended once we reach that 68.75. Like if I know that stocks don't just travel in a straight line forever, something for me, like a good rule for me when I think about entering or exiting stocks, if I'm looking to enter a stock, I don't like to see my RSI on the daily time frame and like the 4-hour time frame. I don't like to see these at overbought areas, because usually if I see those two,
Steph, sorry, I don't mean to interrupt. Ray just wanted you to drop down the indicators so she can see the EMAs that you're using. Okay.
The 9, the 21, the 50, the 200, and the 400. So yeah, so if the stock is at resistance, if I'm reaching resistance levels, this is a good indicator for me. I like to take a look at the daily RSI and the 4-hour RSI. Those two start to tell me if that stock is too overbought for me to start entering it. And I track the S&P 500 because if I start to see that the S&P 500 is at an area of resistance, if the S&P 500 has to pull back, more likely than not, the stocks inside of the S&P 500, the overall market is pulling back, right? So that's why any stock that I'm looking to enter, I also want to see what the broader market is doing. But we started to see in October, see how far we had gotten from the 9 EMA. So now we've had a chance to pull back some, right? This candle hasn't closed. It won't close for the next 6 days. If we do close maybe with some type of bearish engulfing pattern here, that might tell us the sellers are trying to pull the market back deeper. But this candle hasn't closed. So let's go to what has closed. We had a weekly candle that closed today. Let's take a look at that weekly time frame. All right, so overall, we can see that since April, once we broke above my 9 EMA is this blue level here. Since we broke above this 9 EMA, anytime we've really pulled back to that same 9 EMA, we've tended to find support. So usually the rule is once we lose the 9 EMA, we travel to the 21 EMA, should back it up. And you can see just off of this chart where you see here, we were in 2023, we recovered the 9 and the 21 EMA. Anytime we lost the 9 EMA, the 21 EMA held it down. Here it held it down. So more times than not, it tended to hold it down. Now, finally, that was for about 3 years, right? We saw that the 9 EMA holding us down until finally that February, April timeframe of this year, when we lost that 9 EMA, we had a death cross here when a lower period crosses under a higher period. So the 90-20 EMA crossed under the 21 EMA. That was a death cross that brought us to the bottom of this trend. From here, we were able to bounce. And now you guys see here we recovered that 9 EMA. And anytime we've really come to it, it's tended to act as support. So here we touched the 21 EMA today. That's my yellow level here. We touched the 21 EMA this week with this drop. So let's take a look at some levels on the weekly. So I mentioned the levels that I marked here on the monthly time frame. And I like to take my levels from the weekly too. So some levels of support we can watch here. I like this 65.88 level. I'll make my weekly levels in black. Why? Well, since we broke out from this area, and these levels are telling a story, because you guys see once we reach 64.77, you can see how once we approach this level acted as resistance. We have about 1, 2, 3, 4, 5, 6, 7, almost 2 months. We experienced resistance at this 64.77 area. So from that same area, we've now had a breakout. Anytime we were fighting here in the 64.77, we would wick as about as high as 65, that $6,500 area. I'm gonna draw a level right there, because that's what this is telling us. Like they were struggling, right? And I'm going to make it dotted just because it represents wicks. It's not a hard candle, but you see how many times we wicked at that 65.36 level? Because we were fighting here. Bulls were trying to really reclaim this level. They were trying to get a break above this. We couldn't break. It took almost, like I said, 2 months to break out above this level. For almost 2 months, this level was resistance. We finally had a breakout above this level after that Labor Day pullback we had. We broke out. We were able to finally have a breakout above that 65.36 level. So for almost 2 months, that same area was an area of resistance. And if you guys have heard me talk about resistance and support, old resistance tends to become new support. Here, one time, this drop happened that Black Friday, October 10th. We found support at that same 65.36 level. We bounced. We made a new high. And now, so far, we've come back. We bounced right back at that. We dropped right back to that 65.36 level. In the past, that level was resistance. But so far, I like that it's been acting as support. Now, if we start to break this 65.36 area, right, that area in the past had acted as support. So, right, since we broke up above it. So from almost 2 months now, that 65.36 level has acted as support. So if the S&P starts to lose support here, like the same area that was acting as support now to the upside would act as resistance. So if we do start to lose that 65.36 level, I'd be careful that we're not coming to the bottom of this trend line. And the bottom of this trend line is in confluence with, remember, the 9 EMA on the monthly. Also, this trend line, we said since 2022, we've been forming this trend line. And also the 50 EMA is sitting pretty close to this same level. And in the past, once we lost that 21 EMA, we would come to the 50. If we lost the 50, what did we do? We came to the 200. So it would make sense if we do lose this 21 EMA area, that we would come to the bottom of this trend line. Now, if we can't find support at this area, if it's true that we are holding this level as support, because I do have a theory, I'm going to move my weekly chart now to the right, and I'm going to pull up my daily time frame here on the left. But, also to note, so usually the rule is once we lose the 50, right, we come to the 200 EMA. Well, on the daily time frame, that 63.72 level, that same level we were just talking about, that's the 9 EMA on the monthly and also is the bottom of this trend line. That's also the 200 EMA on the daily. So if we're truly losing this 50 EMA, which it really looks like it, I know we're fighting back here, but it looks like we're losing this 50 EMA. It looks like we lost it, we retested, and we continue to drop. Today was just an inside move to what happened on Thursday, to what happened yesterday. But if we're really losing this 50 EMA, we have a death cross here on the daily time frame with the 9 and the 21, we could come, y'all, to that 63.72 area. This is a great level to have alerts set. If the market were to drop to this area, you guys, our RSI, look at the daily RSI, how oversold we are. And don't take it from me. What's happened in the past with the daily RSI? Last time I've seen the RSI and my money flow index, which this indicator here tracks institutional money. Last time I saw these two at the floor like this, just let's look at the charts and see what they did. This was March 11th. This started to flash. Both of these were at this oversold area, right? And we came to the bottom of this trend line. They try to sell this off even deeper. And this is actually an inverse head and shoulders pattern, which is a bullish pattern when we see it as support. And they ended up reclaiming the bottom of this trend line. So just realize that even if this isn't the very bottom, us approaching this area is it's really hard to actually catch the very bottom. But that's why you want to try to catch stocks at a discount. If anything, this drop should motivate us even more to be more disciplined next time. Because when we're here at these highs, they start pumping news, you guys, and you guys saw it. You guys saw all that news that they were hitting us with left and right? All these partnerships. Corey, in my mind, has built like 1 billion databases by now. I was so bullish on that thing. I couldn't let go of them contracts. But, those losses, they teach you something. They teach you how to perform next time if you can take the lesson out of them. So, I learned a thing or two about just being patient, and not trusting my analysis too. But yeah, so if this 65.88 area, like I said, this same area you guys can see since the middle of September, this same area has been acting as support. So if now we're under the 50 EMA though, and we've had a close under the same area. So if we do lose this area, you guys, we could, like I said, I do think we could come to the pretty close to the 200 EMA. But if you start to look at the daily, the 4-hour time frame, it made sense that we bounced today, even if it was just a relief bounce, because look at how extended this RSI has been on the daily and the 4-hour. Like, even to the downside, stocks don't just move in a straight line, even if it was just to the downside. So now we do have the 400 EMA right in this area. I think, the market doesn't care what I think, but from just looking at the lower time frames, this looks to me like there was a head and shoulders pattern here somewhere, maybe with a left shoulder head and a right shoulder. It almost looks like we broke through it, retested it, and then dropped again. But we're still under the 400 EMA here as the way we closed on ES. So again, that's 65.88. I think, in my opinion, that's a really important level. If we start to lose this area, 65.36, under 65.36, 64.77. If we lose 64.77, I would definitely say the 63.72 area. But so that's what I'm watching for ES. Now I wanted to, let me take a look. Let me know if you guys have any questions about that. But I wanted to show you guys something on the VIX as well. So let me pull up this chart on the VIX. All right. This is like the VIX is not the easiest to chart because of what? Because of all these wicks. But it actually becomes a lot easier when you just break it down to areas, like an area of resistance, an area of support. So I'm just going to I'm going to try to break down the weekly chart. You guys tell me what you think, if you agree with me or not. All right, we can break it down together. All right, so just based off of this weekly chart, I'm going to mark this first level here, and let me get a little darker. I know some of our eyes. All right, so this move here in March of 2023, I'm going to go from here. So since this is since March of 23, this is the most recent time frame. So this move happened, let me move this. Okay. This move here happened in October of 23. We came to that $23 area. We rejected. Let me go to the monthly real quick. I feel like I'm missing a level. All right. On the monthly time frame, let me grab some levels of resistance here first. So from where we're currently at, I do see a level here around 24.63. I'm just going to mark that level in red. I see where it's made sense on the past and the monthly. Just see how many times we've wicked at that same area here. It's not perfect, but I know that this is my my nearest swing high. So I'm going to take that point. Now I'm going to go back to my weekly. I like my weekly chart more for the VIX. Okay. So that $23-$24 area, this red and black line, you guys can see that pretty much since the end of December. Here we tried to break out above that $24 area. And it looks like we got as high as around 27 on the weekly. Okay. But here, when we broke out above that $23 area, we went as high as 27. We wicked. When we got above this $27 area, it looks like we wicked as high as around 65. Okay. So this is just information, right? We're just gathering information from the chart. So here I can see where that same level, that $23 area, acted as resistance. Anytime that I broke above this $23 area, I see where I touched that $27 area. See here where we broke above this $24, $23 area, we touched that $27 area. Anytime we were able to break above this $27 area, looks like we went as high as pretty close to that $60 area. So this was that drop from April. If you guys remember, this was that August drop last year. This was that drop from April. This was that Black Friday, October 10th move when we were able to break out of this resistance area for the VIX. We had been in this downtrend here. This move here happened October 10th. So, but you guys see the story, the moral of the story is that anytime we've really had a break above this $23, $24 area, it looks like we've gone as high as around that $27 area. So even this week, we touched that $27 area. But so far, we've rejected. But the VIX has been fighting it because there was about almost 6 months the VIX had been consolidating inside of this range. And so imagine that's like when something breaks out of a tight consolidation like that, right? And so if the VIX is the inverse of SPY and the VIX has been breaking through resistance levels, right, then it broke out the resistance, came back and retested that same resistance when ES made new highs, and everybody was super bullish, but the VIX had just come back to retest that same area that it broke out from. It came to retest and then continued this breakout. So the level that I'm watching for the VIX is really like this $27 area, even as high as 29, but to be safe, we could even say around 29 because there's an area here. But this area, if we start to break out above this 20, we can even say 29, above 29, you guys see anytime that we've broken out above that 29.69, we've gone as high as 65. So I would keep those levels in mind for this recent volatility, because the level for ES, if ES starts to lose 65.88, we have this hypothesis that we could be dropping to the bottom of this trend line. So if ES is losing 65.88 and the VIX is breaking above 29.62, you know, you guys can start to form your own hypothesis with what might happen there. But those are the levels that I'm watching for the VIX. You know, I didn't love that the VIX actually ended up closing this week above this 21.72 level. That candle was actually from the move that happened in October, the top of this move here. And so we had, if you zoom in, we had been rejecting the top of this move. Here we go. We had been rejecting the top of this move. See how many times we wicked under it? And we actually had a breakout above that to this week. So watching the VIX, you know, break out, continuing to break out through resistance levels, it makes me kind of feel like it's trying to get that break above 29, but it hasn't done it yet. And I will say, if we pull up the daily chart, so that's the weekly. Let me pull up the daily here on the right. If we pull up the daily chart, the last time the RSI looked like this was that after that whole move, that dump that we had in October when the market pulled back in mid-October. This is the last time the VIX was at that $29 area, and look at how the RSI looked. So we're back at that same area, and look at how the daily RSI looks. Daily RSI looks like it's at those overbought areas, and the 4-hour RSI also looks like it's overbought, and it looks like it's actually created a head and shoulders pattern. The Huda kind of taught us that with how the RSI can also create patterns in it. And there is bearish divergence, because if you guys see on the candlesticks are trending up. You guys see how we're trending up here? And the RSI is actually trending down. My trend line should actually be up here. See how the RSI is trending down? So that's actually bearish divergence. That's a sneaky way to that sellers end up showing up. So we have bearish divergence. We're approaching that $29 area. So that's the area that I'm watching for the VIX. If the VIX can break above 29, then I'll believe it. I do believe that the market will pull down deeper. We probably will lose that 65.88 area. I think the VIX comes to 65. Here, you guys, that was the buying opportunity in April last time we reached that level. You know, that last time the VIX reached 65. So if we break 29 and get to 65, just remember me, okay? Just remember what I said. All right, so let's get into some stocks. So we have some levels from ES and the VIX that we can watch overall for some direction. Now let's look at some stocks, because Microsoft has had a lot of our favorite stocks have had a deep pullback, and Troy requested that we chart some stocks too. So let's get right into it. Let me make sure. Am I okay with time, you guys?
Yeah, you're good with time.
All right, let's do this. Okay, so this is Microsoft. You know, Microsoft's one of my legs, so you know I always keep my eye on her, and I'm not too pleased because I'm with what I bought my shares this month. But you can't always catch the perfect bottom. But let's go ahead and get into the chart. So off of the weekly, just some information we can get off the weekly. You guys can see pretty much how tightly Microsoft has followed the 50 EMA, which is the darker green here. Anytime that we've really lost the 9 and 21, the 50 and the 72 EMA, which is the lighter green, have really held us down. Thank you to Ian. We got that 72 and that 400 EMA from him. So here you guys can see where we started to lose that 50, we dropped to the 200. Anytime really Microsoft has pulled the 200, I mean, really, when have you seen it at the 400 EMA? In 2013? Like, this was a while ago, right? More than 12 years ago. So but this purple level here, anytime you've seen it at the 200 EMA, it's tended to be a buying opportunity. It's proven to be a buying opportunity. This was from April's recent decline, March, April here, where we touched the 200 EMA. But for the most part, you guys see where Microsoft has tended to respect the 50 EMA. Even if it's lost the 50 EMA, the 72 EMA has tended to back it up more times than not. So let's take a look at where we're currently at. So Microsoft is currently this pullback that happened this week. They definitely did pull us back to this 50 EMA. Another level that I can see that Microsoft is at, this same level in the past for Microsoft had been a level of resistance. You guys see in July of 2024 where we touched that area, and let's see, it was like we finally had enough gas to break through 446. Even lower here. Yeah, 431. It looks like here we were fighting with 431, broke out to 467, and then didn't have enough buyers, and they broke us through support here, brought us to the 50 EMA. Here we consolidated right at the 50, between the 50 EMA and that 431 level before they exhausted this, and they brought it to the 200 EMA. Here, finally, we gathered enough buyers in April to not only break us back above 431, but finally give us a break above 467. So we finally had never been able to break out above 467. That area had been major resistance. And finally in June, we had enough buyers to break Microsoft out above 467. We know that rule, that trading rule that says old resistance tends to become new support. So if you guys see, Microsoft, so far, they've pulled us to that 467 area. We're right by that 50 EMA. This RSI on the weekly has had a chance to cool down. I like that. I will say that we lost that 478. Let me show you guys. So in the past, that 495 had acted as support. Since we reached this level, since June, 495 had been acting as support. So this week, we actually lost that level. I didn't love that because this looks like a double top here. And then anytime we broke 495, that's what brought us to 478. But we even closed under 478. So now they've brought us right back to that breakout area. And we, like I said, the trading rules, usually that old resistance tends to become new support. So it was old resistance. It could become new support, right? We have this, they wicked right at that level today. On Microsoft, and they ended up fighting back bulls at that level, at least this week so far they have. So let me take a look and see if I'm missing anything from the monthly. Okay.
Hey Steph, I don't know if you noticed it, but I had zoomed out on Microsoft too and noticed a double top, and I wish I had noticed that sooner. Both of those strong wicks there, if you zoom out, and also where you marked off the neckline, which was like around that 494, 92 line. I wish I saw that before, because
this didn't close till this only happened yesterday.
So, and that's the thing that kind of sucks, because in the candlestick trading Bible that I have, this is not financial advice by any means. I would never really short Microsoft, but when you do see a double bottom, once you see that it cracks that neckline, that is quote unquote should be a solid entry point if you were shorting that company. But like, I wish I had the patience, because I kept following Microsoft when I seen it kept bouncing to like 510, and I was like, oh, it's developing support here. But again, I was just too early for it, and then it went sideways on me.
Yeah, but I mean, breaking this neckline, if for example, somebody that was probably saying like, oh, I'm going to take this as a day trade, like I'm losing 495, targeting 478 would have been a valid short. I can show you how that happened, but it wasn't even the easiest to short, because they broke it, they came back and retested it, and then finally dropped it. This happened yesterday into today, and targeting that 467, but it's like, that's why it's important to know even where are you shorting a stock to. Like, yeah, okay, you could have shorted this, not you, Huda, but anybody else, because like shorting bullish setups, it's like it can be difficult too, because if people don't know when to exit, they can get stuck in a short position, and the market's, they're bullish stocks. Like these are stocks that on the long haul are bullish. People are looking for entries on them, but yeah, that definitely good eye on that. Yeah, so this was a weekly neckline, so like the Huda said, if this is a true double top, this would have been the neckline here. So on the weekly, so us losing this level 495, you could have said it could have been a short, because you could have said, wow, this is a double top here. You could have shorted probably the bottom of this area, like 478, like we were just saying. So yeah, for sure, good eye with that. Okay, so yeah, so with Microsoft, also I think I just showed you. I drew that while Jehuda was talking. If you guys see on the monthly time frame, this trend line too that I just drew out here, see here how it acted as support. See here again how it acted as support. 1, 2, 3. Here we have another tap. All right, so I just wanted to highlight that area. Okay, so let me bring back the weekly. Sorry, here on the right. Okay, so yeah, weekly here, daily. All right, so we're at the 50 EMA, all right, on the weekly time frame. That's this green level here. We said that we potentially could, because a lot of people are going to think this is a double top and try to continue to short Microsoft. But like we said, this area acted as resistance in the past. Shorting Microsoft here at this area that could be support, old resistance can become new support, is very dangerous. We're at the 200 EMA on the daily time frame. That's that chart here on the left-hand time frame, with the RSI on the daily at those oversold areas. And the money flow index pretty much matches. Look at last time that Microsoft had, the last time Microsoft, this was April's move, looks like, when we reached the 200 and 400 EMA area, the bottom of this trend line. This was when the money flow and the RSI looked pretty extended. We ended up finally finding a bounce there. So even if it's not the perfect floor, these aren't the areas you want to short, because now it's like you're thinking like of a risk to reward. Like, what's the probability this thing continues to drop? We know we have the 400 EMA here sitting on the daily time period. Like, if the 400 EMA represents 400 days, that's more than a year of price action of Microsoft. So, you know, I get it, people that are in and out, but trying to open like long-term shorts on a stock like this, like that's really close to areas of support. Look at the 4-hour RSI, the daily RSI, they're all matching at those super oversold levels. So yeah, I mean, I like Microsoft setups. If we do lose this 467 area, you know, that same 431 area could be an area that acts as support. That area in the past that acted as resistance, and that's getting pretty close to the bottom of this trend line. So, but I think that Microsoft's getting pretty close to that area where, you know, she at least could bounce for some relief. All right, I want to take a look at Meta. All right, Meta has a trend line pretty similar to Microsoft's that I like. This is off the weekly time frame. Let's draw this out. I think this is a pretty good, it's not perfect, which they rarely are. Let's see. I don't know if this one's going to make sense. Actually, I think this does make sense. Here we go. Okay. On the bottom, this trend line has acted as support more times than not. See how we have one point here, another point here. This was that April time frame. We chopped around here. We tried to lose it, but we recovered it. And then lo and behold, look at where we're currently sitting at. This is this week here. We just closed. You see how the top of this has acted as resistance more times than not as well. Here we formed an evening star. They pulled us all the way back down to the bottom of this trend line. Here we came to the top of this trend line, consolidated for a while before finally exhausting itself and coming back to the bottom. So if we loved Meta up here, what should we think about Meta down here? We've been forming this lower trend line since looks like January of 2024. So for more than a year, almost 2 years now, this lower trend line has acted as support. We're in confluence here with the 72 EMA. And one of the tidbits that I mentioned at InvestFest, I love to use my RSI in confluence with different time frames. So like when I start to see my weekly RSI at the floor, so note this RSI on Meta approaching those oversold areas. And then come here on the daily time frame, look at Meta, you know, at those oversold areas. And then I come to my 4-hour, also Meta, you know, getting close to those oversold areas. It helps me to start forming that theory, right? Like that I could be closer to areas of support. So I think Meta's sitting at the bottom of this trend line, and this is an area that, you know, buyers definitely, I think, could step in. On the daily time frame, we're sitting right at the 400 EMA. You guys see here. And we're back at the bottom of this trend line. Look at this RSI. I mean, if you think from a risk to reward scenario, you know, does this make sense to short this stock to the downside? I'm not saying it couldn't drop more. They could drop Meta if they're really losing the 50 and the 72, but it's like that's where it's like, okay, risk management. I'm bullish on Meta currently because I think Meta's sitting at support. I think it's sitting at the bottom of this weekly trend line. I see that for the most part, it hasn't ever navigated that far from the 72 and the 50 EMA. I'm starting to form these wicks to the downside, like buyers are trying to buy these dips up at the bottom of this trend line. But if I start to lose now this same trend line that I'm bullish because I'm holding on to this trend line, like, and it, obviously you'd have some levels of support and resistance here, but I see from just this chart where I'm inside of this move, like, let's see, everybody makes their support and resistance levels different, but for me, losing this 594 area, if I can't hold this 594 area or reclaim it, then I see where Meta could come down to 556. For me, this would be a line in the sand. If I start to break 556, I'm like, nah, this is breaking a trend line. I got to accept that, Yes, for 2 years, it acted as support. So if I'm losing 2 years of support, that's showing me weakness in the stock and that it could come down further. So I'd rather let it pull back deeper. And this is just my strategy. Everybody operates differently. Some people wait for that pullback to average in. But for me, I'm like, if the same reason that I'm bullish is because I'm holding support levels and I'm starting to lose those support levels, and how much I have to have an area where I change my bias because I don't want to be caught up in some huge drawdown. And if Meta's losing support at 556 and ES starts to lose, right, that 65.88 level, and the VIX starts to break above 29, doesn't that all feed into that same hypothesis? So, all right, let me keep going because then I won't get to the important ones. All right, so let's get into Fibronet. If you were in Troy's options class last night, DeHuda and him definitely cooked. Great class. If you didn't check it out, make sure you catch the replay. Let's start with some trend lines here too. All right, I'm gonna get it better. Don't worry. All right, I guess it's not perfect. It's not perfect. I mean, I would say I have more touches than that. This upper one looks like but it definitely looks like I have a break above it. Let's take a look here. Let me see if I can form a lower trend line that makes sense. All right, I feel like I have enough points here that make this make sense. And here also I can see where it's been respecting the 50 and the 72 EMA. Here it looks like we started to break out from this trend line. All right, so let's take some information from this chart. All right, so we started to break out above this trend line. Looks like on the monthly time frame, I could see where that 330 area gave it some resistance. We finally had a breakout above that area. This candle here, the top of this move, this is September's close at 364. And this move here, this is October's candle, and October closed at around 440. So I know that if the month of November wants to continue what looks like a breakout from this channel, we'd have to get above 440 for continuation. So that is October's close. All right, so that's my monthly chart. Let me grab the weekly. All right, so we formed this evening star pattern here. This shooting star here at resistance, this started to show us already that this was going to pull back with this bearish pattern here right at resistance. But let's track some levels. So, all right, above that 364, 390 looks like it was a key area. You guys see how once we broke out in early September above 364, we kept on chopping around right under that 390. What is that, 383? Yeah, we were consolidating right under that 383. So that 383 was old resistance. This candle finally gave us a breakout above that resistance level. And now they've pulled us back to that same area that in the past was resistance. Is this support? Is 383 support? I'm going to put a question mark here. All right, so we're at the 9 and the 21 EMA. All right. And that's what's 364. Let me put Fibronet. Okay. So this level here, this is what we've said in the past. This level had acted as resistance on the monthly. You guys see that? That's the 9 EMA on the monthly too. All right, and you guys see how closely Fibronet traveled on the 9 EMA. So this is the furthest it's really been for a while. The 9 EMA looks like it's right around 330. Okay, so let me pull the weekly here to the right. All right, the daily time frame. We closed today with this hammer candle, this green hammer right at this same area, that 383. We see that area was old resistance, and we're looking to see if that same area is support. So it looks like they're fighting back at that 383 level. On the daily time frame, looks like we had broken out above that 72 and that 50 EMA back in April. And ever since we broke out above that, we've held a line above the 50 and the 72. There are these two green levels. Anytime we pulled back under it, this was back in August, we dropped, we recovered right at the 72 EMA. But you guys see, we hugged the 9 and the 21 EMA pretty close. But if we lost the 9 and the 21, which here have crossed, but we're right at that 50 and that 72 EMA. So we're right at a key area, right? This is like a key area. Does this 383 level really act as support? This daily RSI is getting closer to oversold. Let's take a look at the 4 hour. The 4 hour also looks closer to oversold, but it looks like they're trying to break this under 383. So if we lose 383, that next level of support is September's close. That would put us at 364 with the 400 EMA in this area. But this whole area looks like, it's an area that can act as support. Now, I think my favorite entry for Fabrinet would be around 330, because 330 would bring it right back to that 9 EMA. And you guys see how that 9 EMA has, it's been a magnet so far for this stock. So that same 330 area, if they were to pull Fabrinet back here, that's an area that I would look to see if buyers show up, because I know the 400 EMA is sitting here at the same area. So here's an area that we could potentially bounce, but we'll see how we open up on Monday. But this thing, losing this 383 area definitely tells me that it looks like we're coming to this 364. So if that 364 can't act as support, 330 I think would be next. This would be a key area that I would look to see if buyers step in. But it would also be my stop. Like, I think that's where it kind of makes it easy. Like, if I'm bullish because I think I'm breaking out from this channel that I've been consolidating inside for all of this time, if I'm bullish because I'm breaking out of this channel, then I got to hold the break of this channel, because if I start to enter back down and start to break under that 330, that tells me I'm rejecting the top of this channel, and I potentially could be coming back to the bottom of here. And if there was an ever, the best entry would obviously be the bottom of this channel, but who knows? I don't think Fabrinet comes back to 164, but again, the stock market doesn't care what we think. That's why I respect technicals. All right, so let's do ScanDisk. All right, let's draw us a couple of levels. All right, so 200 is the top of this move here. This was October's close. Let me know, you guys, if there's any questions. All right, this is October's close. This is October's open. All right. So the way that we close this week, it does look like an evening star pattern. If we see these patterns at resistance, they can be bearish patterns. But it looks like even though we formed this evening star pattern, we're right above the 9 EMA still. Looks like we've been holding the 9 EMA but this is definitely an evening star pattern. These tend to be bearish patterns when we see them at resistance. So the way that I would really look at this trade, let's see. There's another level here. Looks like on the weekly. There's a black level right here at that 185. 185 is the top of this move. You can see how this level had acted as support. Look, since the end, so for about a month, when we broke out above 185, anytime we've pulled back to that area, it's tended to act as support. And this is also the 9 EMA on the weekly. All right, so I'm gonna under 185. We do have access, looks like, to 145. If we break under 145, looks like we have access to around 128, but we don't have that information yet. So let me pull up. All right, daily. All right, so we're under the 21 EMA. Looks like we got pretty close to the 50 EMA today. Now ScanDisk, if she's still cooling down, if she starts to lose that 185 level, I would say she could be coming down to that 145 area. but the 72 and the 50 EMA are coming down here. I'd let this, well, obviously this is not financial advice. Everybody makes their own decisions, but this showing a bearish pattern here at these resistance levels in the market in the middle of a pullback, you know, that tells me that this thing could be cooling back deeper. 145 would be my favorite entry for this stock. I think that's a great area to have alert set. That same area in the past had acted as resistance before breaking out to that 185 level. So, you know, if this area doesn't act as support, if this 185 area doesn't act as support, this 145 level could. Let's take a look at what the lower time frame says. The 4 hour now is at pretty close to those oversold areas. And now we're approaching the 200 EMA on the 4 hour at that oversold with the 9 EMA on the weekly here. So, you know, if we bounce here, the buyers could fight back at the same area. So to the upside, if we can get if Scandus can get a break above 211.35, and we can break and hold and start to hold above this 211, then we'd have access to at least 240 here. You know, and so I'd say above 211, they could try to invalidate this evening star pattern if this is some type of fake out. But if we really start to lose under 185, careful, because this thing could come to 145. That's kind of, I like to have a case for both scenarios. I don't like to have just a bias saying it's going to go up. I like to have a bull and a bear case. So I like to know what levels. So I know if I break 185, I'm also losing this area where the 200 EMA is. And on the weekly, it tells me, well, this week when we lost 185, looks like we went as low as around 164 before buyers step back in. So we could put that information in there. And I like to, like, my wick, any levels that I wick at, I usually just like to make them dotted, make them a little different. So I have that information. Like if I start to lose 184, I could come to that 164 area. If I lose 164, I know I'm coming to 145. If I lose this area, this acted as support in the past. If this area can't act as support, then, you know, I'm probably coming back to the bottom of this candle here, 145. And that puts me pretty close to the 221 EMA on the weekly. So I think that's a good area to have alert set. 21 EMA at that 145 level, because that's also the 400 EMA. All right, so that's Scandic. Let's take a look at MicroStrategy, and then I'll let the Huda do his thing. Even though I really want to look at Bitcoin with you guys, but I'll let you guys.
You can do the Bitcoin too. You good?
Okay. You good. All right. So with MicroStrategy, this trend line, if you guys see, this has been since December of 2020, the end of 2022. Anytime that we approach this trend line, you guys see where it's tended to act as support, but we lost that same trend line. MicroStrategy started to lose this trend line, and the 21 EMA and the 9 EMA is crossed under the 21 EMA, giving us a death cross. That brought us to the 200 EMA on the weekly. This RSI is pretty oversold. This is pretty oversold on the weekly time frames. I'm curious. I already know what it looks like on the daily, but I'm excited to show y'all. All right, so let's read this chart a little. Let's talk about MicroStrategy. This is from 2020. If we start off here, from 2020, we got as high as about 130 before wicking, coming back down, consolidating. Right, looks like we consolidated right under that $85 area. That area was resistance. After we rejected that 130, we came under 85, and when 85 acted as resistance till we broke down. We found a base down here, looks like between 35 and 14. Okay, whatever. So we finally had a breakout above that $35 area that had acted as resistance. I'm just telling y'all this story so we can start to kind of understand this move that she's made. All right, so at 40, she reached 46. Here she had rejected in that same area. She rejected again, pulled to this trend line, found buyers, was able to break out above this area. Got pretty close to that $85 area, rejected here a little before finally breaking out above that area. And then they got to that 130 area. In the past, that area had acted as resistance. But here they started to consolidate right at that 130 area, between 130 and looks like that was between 130 and okay, here we go. And 178 looks like was the high of that consolidation. So you guys see between this area right here was an area of resistance. They were just consolidating. They were in a bull flag, impulse move, consolidation before finally breaking out. So that area was major resistance for MicroStrategy, right? And we finally had a breakout above that area. That breakout took us as high as around 441. Here we go, 441. So we approached this area in December of last year. We pulled back. They pulled us back to the the 50 EMA, and they tried it again. They tried it in April. They tried it again, looks like in July, and both times they failed. So here they formed a double top, which is a bearish pattern. You know, when we see it at resistance, we just talked about that. So they brought it to the 50 EMA. We lost a 50 EMA. We lost this trend line. And now they've pulled MicroStrategy all the way back to this 178 area. This is the 200 EMA on the weekly. MicroStrategy losing that 170, the top of this 178, tells me that it could approach this 130 if it really can't reclaim this 178. But this RSI is definitely getting to those oversold areas. So I mean, 130 would be my favorite entry for MicroStrategy. I don't know that it gives us that, but it would be my favorite entry. But this 178 area is an interesting area as well. Let me pull up the because us losing that trend line is showing weakness with MicroStrategy. And a lot, really the rule of those trend line breaks is that we're supposed to come back down to meet with the bottom of this trend line, but I can't imagine that they would bring MicroStrategy to $14. So if we just take a look at this chart, you know, the 200 EMA represents 200 weeks of price action on a weekly chart. Now the 400 EMA is double that. It's 400 weeks of price action. So the 400 EMA is sitting right under that 130 area that we're saying if we can't reclaim that 178, we could come to that 130 area. So let's take a look at a few things. Let's look at the daily RSI. Definitely oversold. But you guys see that weakness here with us losing that 178 area. Looks like after hours. Where did they bring us? But now this candle here is showing us there was a fight here between the bulls and the bears. The open and close was pretty even for this with the RSI oversold. The 4-hour time frame definitely oversold there as well. So, but if they can't reclaim this 178 area, you guys, careful because they could be dropping us to that 130. But at that 130 area, I would think twice about being too bearish on MicroStrategy. The 400 EMA is sitting right here, and all of these time frames are starting to flash oversold, at least with the weekly, daily, and the 4-hour. The monthly time frame since 2023, MicroStrategy hasn't lost a 50 EMA. Ever since it broke out from that 50 EMA, it hasn't lost it. So yeah, so that's kind of what I'm watching for MicroStrategy. Lastly, before I go, I wanted to show you guys Bitcoin's chart. I'll explain the levels I have here, at least on the weekly time frame. This weekly chart for Bitcoin, I asked Austin, I was like, Austin, we really got to talk this because I wanted to buy Bitcoin. I wanted to, buy some more Bitcoin, and us breaking this 50 EMA, and you guys see this channel, right? You guys, this has been since January. We've been inside of this channel where this lower trend line has acted as support, and it's in confluence with the 50 EMA. So you guys see here support, support, support. And here we started to break this trend line. So us breaking this trend line and losing this 50 EMA, the rule of losing the 50 EMA is that we come to the 200. Now, something about that $71,000 area is that if you guys look at just this channel, you guys see how this same area was, let me move this. Here we go. At March of last year, March, April, all the way to the end of last year, Bitcoin consolidated right between 71,000 and 61,000. We had all of this consolidation. There's like some type of trend line here. There you go. You guys see we were consolidating under this trend line. Finally, we had this breakout at towards the end of October of this was literally October of last year, you guys. And we're like, oh my God, the market is collapsing. But this was the end of October. This was a little bit more than a year ago that Bitcoin was between 61 and 71,000. So this area acted as resistance. We had a breakout above 71,000. We got pretty close in April, March, when all of us wished we had bought, the 50 EMA here. We got pretty close to that. That same $71,000 area that was in the past had been resistance. It ended up acting as support. Here, a bullish engulfing off the weekly time frame off this trend line was a great signal that buyers had stepped back in. Just trusting even this signal would have sent Bitcoin from 77,000 as high as 125,000 off this weekly bullish engulfing off the 50 EMA. but technical analysis doesn't work. So we've currently pulled back to this $78,000 area. In the past, we bounced right at that $78,000 area. If we lose 78,000, I do believe the Bitcoin comes back to 71,000. And that $71,000 area is, that 200 EMA is right by that same area. But look at this weekly RSI, how it's getting to those oversold areas. Look at how Bitcoin's reacted in the past to being oversold. Bitcoin respects technicals too, but trust and believe. Look at here. So look at where the RSI is currently at, which we haven't been this low in the RSI since November of 2022 was the last time that the RSI was this extended. And look at the run that happened from the RSI being that extended since last time. Right? We came off that 400 EMA and look at this run. So the closer this gets to the floor and 71,000, the more it makes me want to go throw my pennies into that thing at Walmart, so it can give me money, so I can throw some more money at Bitcoin. But yeah, that was Bitcoin. And yeah, that's it. That's all I got for you guys. Let's see if you guys have any questions.
He said, "Not the Walmart."
That's funny.
I'm looking for. I've been throwing so much money at the market. I'm like, with a drop, with a drop.
every day is dropping. I'm like, where am I going to keep getting money from? Like
that part.
I'm like, payday! Come on, payday! I need.
No, I hope Bitcoin gets down that low. I'm gonna buy that thing and hold it for the next 10 years.
You know what's funny? Actually, as we brought up Bitcoin, I was looking at my chart and I had drawn in one of those fair value gaps on the weekly time frame, and if I extend it all the way out to like this week, that's crazy. I mean, the week is not over yet, but that last weekly candle, the wick is literally at the top of it, of that fair value gap from the week of November 4th, which makes sense because everything jumped up after Trump got elected. That's interesting. And then the midline of that fair value gap is at like 76,855. It's interesting.
Mm-hmm.
That's actually interesting to see how that pans out. But I also I liked how you went over Meta, because I also wanted to share another confluence that I saw too. For those of you who use the MACD, when you look at the MACD even on the daily time frame, you'll see how sellers are starting to get weak. Like there's a bunch of lighter red histogram candles, and then also as for the 12 and 26 moving average on the MACD is starting to flatten out and reverse its trend to the upside. So I really like where Meta's at right now. I'm just waiting on that full confirmation of buyers actually stepping in and taking control.
Mm-hmm. I'm shocked Meta got this low, but
Me too.
What goes up comes down, and like sometimes you just get attracted buying prices and entries in some stocks.
Facts.
I'm shocked Meta's at 600. I remember Meta being at $67 after COVID.
I remember trying to decide which one I was going to buy, Amazon or Meta, back when it was in like the 80s.
I remember trying to short Meta at $75.
My fiance's uncle laughs at me now because I used to crap on it so much because everybody was like just beating up on Mark, and then he was like, you know what, I bought. And now every time he sees me and you talk about Meta, he's like, huh, how do you feel? Because he bought when everybody was crapping on it. And I'm just like, yo, just leave me alone. Just leave me alone. All right. Let me see. Any other questions? Somebody asked.
But I think that the VIX, you guys, I really hope you paid attention to the VIX, that chart on the VIX. That $29 area holds a lot of answers for us on whether we're going to continue this drop or not. All right. So that is a gem for you guys. I really took my time. I really wanted to show you guys that.
Yeah, facts. This is going to be one of them ones for everybody to rewatch as well, for sure. Somebody said, can you explain averaging in on an option contract a little more? What exactly do you mean by that? As in regards to like when would we average in, or just the whole concept of it?
But I mean, basically, like if you're averaging into an options contract, so like Like, for example, we can even like bring up Meta. Like, let's say you recently entered Meta because you saw it drop after earnings and it dropped to around, let's say, I think it dropped to like 600 first. Let's say, hypothetically, I'm probably wrong, but okay, it dropped that to 600. The contract was at a discount. So let's say you bought that contract at around 2,500 for sometime next year. And you say, okay, Meta's continued to drop. It dropped and it hit 571. So you say, okay, I'm going to average in here. Now I'm going to go into my full position and buy the rest of the contracts, whatever many contracts you wanted to buy, I'm going to add my full position now with this further decline. That's a way that traders sometimes average into a position, you know, with like realizing that the market is pulled back, but not trying to catch the exact bottom, but still catching a good sale. It's kind of the mentality behind it, because that just lowers your average on your options contract. Because now if you entered at 2,500 initially and the stock still dropped another $30, that contract is also taken, it's also lost value, right? So you could probably buy more, or well, you will buy more at a cheaper price, which would bring your overall average down depending on how many you buy and how many you have.
Yeah, exactly. Isn't it averaging? Yep, that's exactly what it is. But yeah, let me get through my slides. I'm going to be doing essentially a continuation of yesterday. I also plugged in the Monte Carlo scenario, bear and bull case for NVIDIA, since that has been the main topic of conversation all week. So I'm gonna jump right into it. And I know a lot of people were asking, like, oh, like, you know, what were some of the prompts that you had and whatever, you know. So for this, we start off. It says the standard Monte Carlo doesn't work for catalyst stocks like Nvidia, Microsoft, Meta, Broadcom, which was interesting. So the traditional Monte Carlo assumes returns are random, the drift is stable, volatility is normally distributed, and there's no structural breaks. And that's claims that it's fine for those companies like Visa, Pepsi, or Costco, but AI cycle stocks break every assumption. So because they move different from those other companies that I mentioned, it needs to follow a different model. And why? Because it claims that Nvidia moves in different in shocks. So once it hears news about chip shortages or hyperscale capex cycles, there's a new chip coming out. You have the government AI investments, a bunch of different variations that can cause Nvidia stock price to jump quite drastically, right? And it's saying that the traditional Monte Carlo cannot see it. So you need to find which model will best be suited for that type of stock, which is something I learned. I did not know about that. So I wish I can get this out of my way. I can't really see what that's saying. 1 second. Okay, so what model can capture catalyst-driven moves? So it gave me two. So one is the Markov regime model, and it divides the market behavior into regimes such as risk-on AI boom, neutral growth, risk-off recession, high volatility events, post-earning drifts expansion. And each regime or each model, they have different drifts, different volatility, different tail behavior, and probability of switching. And it also shared that this is exactly how banks model tech companies with structural catalysts, i.e., NVIDIA. And the other one is jump diffusion, Monte Carlo, or Merton or Bates model. And so this includes a normal drift plus volatility plus jumps representing catalysts. So that can be the new GPU cycles, a major earnings beat, cloud partnerships, regulatory decisions, export bans, which we constantly have been hearing about in the news with China, Fed pivots when it talks about the rates, and other macro shocks. And so this can capture upside bursts on NVIDIA's, like when they make a 20 to 30% earnings gap. So it's accounting for all of these different scenarios. So again, we were talking about buying quality companies, looking for area of support, and buying time. So the bull case for NVIDIA that we came up with from 12 to 18 months out, which they considered a high probability catalyst, including high probability catalysts and structural tailwinds. So one would be the AI infrastructure demand continues to outgrow supply. That is a catalyst for the bull case in NVIDIA. So that could include Microsoft bookings, Amazon, Meta, Google, all raising their AI capex, OpenAI securing 250 billion of Azure GPU commitments, and NVIDIA still remains the foundation for AI compute, right? So this can create sustained multi-quarter pricing power. And then we also have their Blackwell GPU super cycle that begins this year into next year. This is their earnings driver, higher margins, their CUDA ecosystem. Wall Street expects Blackwell cycle to extend NVIDIA's dominant runway through at least 2027. So the drift, a part of the model that, which is a part of the model, increases as new cycles hits revenue. More catalysts. So the AI software plus the CUDA ecosystem accelerates. So the software is now 15% of NVIDIA's revenue, growing faster than its hardware. Okay. CUDA lock-in equals high switching costs, enterprise AI adoption expanding across finance, medicine, science. NVIDIA is moving into recurring revenue streams. And in yesterday's presentation, I talked about how it's important to focus on those companies with strong recurring revenue models. So this model support higher long-term margin expansion. Another catalyst, rate cuts. As we just mentioned earlier, they have now said that there's a possible probability that they actually will cut rates again in December. Most of them I've seen are saying 25 point. So that serves as a catalyst as well. Lower rates equals higher valuations for growth in AI compute companies. And again, it continues to support multiple expansion into these upcoming years. Fifth bullish catalyst. And now when it comes to the technical structure supports, where am I grabbing this information from? So this is part of the questions that it asks as I'm trying to get the answers from the model. It's saying, all right, I'm gonna need you to give me some information. And before I continue, I wanted to share with you guys exactly where I go for that and how you guys can do it too. Let me just share my screen here. So I mentioned macrotrends.net yesterday. So this is macrotrends.net. You'll type in NVIDIA and this is your screen that will pop up, and you'll click on prices here and it'll literally tell you the last closing price, which we see is 178.88. You see their all-time high, you see their 52-week high, you see their 52-week low. And we see NVIDIA is currently at 18.6% off their 52-week high. When you go lower, I think my screen is like frozen. There we go. Can you guys see my screen still? Or at least see where it says download data?
Yes.
Okay. I think my screen is just moving a little slow right now.
Wait. What is it supposed to say?
It's just, you should start seeing a chart, like NVIDIA's price chart, and there's a button that says download data.
Yes.
Right above the chart.
Yep.
Okay, yeah. So if you guys don't want to like use your actual chart, whether you're using TradingView or if you're using Thinkorswim, you can simply just come to macro trends and click download data, and it'll upload a spreadsheet for you, or like off rip. Once you have that spreadsheet, then you can go ahead and plug that into whatever AI model you're using and have it analyze that information. And again, we saw it showed like 26 years, I believe it just said, of NVIDIA's price history. So you have all that data for it to collect. And then also, I went on to bar chart as well. And you can, on bar chart, they give you, when you go to the price, the performance report, it gives you like 52-week key points. It also shows you different areas of support on that. It's typically on the right-hand side, if I'm not mistaken. And, you can utilize that information as well and screenshot it and plug it into the AI model so that you're giving it accurate data. So we came up with like the monthly support, which is where I also had visualized when I was looking at their chart. because I saw that was where it was previously struggling a few months ago. And it looks like we just bounced off of that area, or just about right at that area. The 4-hour 400 EMA, were typically right there as well, I believe. Let me just double check. Yeah, we're right above the 400 EMA on the 4-hour, so I plugged that in as well. I just made note of where the 200 EMA was at, and then also utilizing Fibonacci retracements from bar chart, and plug that into the AI model as well. And historically, NVIDIA tends to, it's not all times the case, but it bottoms around that 200 EMA during macro fear. So with that information, it gave me the probability of bottoming between 161 to 180 is very high. Okay, cool. So with that information, it then gave me the bull case range over 1 year to 18 months is between 215 to 260. And that's based on catalyst weighted Monte Carlo and historical AI cycle behavior. Right. And so that's good and all, but we also want to be able to identify the bearish case. So what do things look like for a bearish case for NVIDIA for the next month, year and a half? So that's going to include macro plus geopolitical and supply constraints. Export bans, cut off China revenue. We talked about that yesterday. This model applies a 3% drag to drift for those export bans, right? You have the AI capex, which could slow in a recession. Everybody's screaming recession for the longest now. But again, this is keeping that into account. If global recession probability materializes, hyperscalers temporarily pause spending, enterprise AI projects get delayed, data center build out slows down. And that's going to reduce the demand for all the chips that they have. And for that, they applied a 5% recession drag on the balanced model. All right, and competition tightens. We've talked about AMD being that second player in the space. TPU, I believe, is I think those are Amazon chips, I believe, and Llama is Google, if I'm not mistaken. So nobody's really close to NVIDIA's end-to-end stack, but their competition is not that far behind them. So their fragmentation risk remains real. You know, there could be slow adoption, compressed margins. And again, this is in a bearish case. You know, we're talking about recession. We're talking about slowdowns in the market. Shift some revenue to in-house chips, as we see. We've heard Meta talking about designing their own chips. We've heard Amazon, as we see here, designing their own chips as well. So the next thing would be bearish case was overextended valuation follows earnings mean reversion. So NVIDIA typically experiences deep pullbacks during product transition cycles, macro fear, Fed uncertainty, which we are currently literally in the middle of, rising yields. And it states here that NVIDIA is currently about 17 below their all-time highs, and it's already past historical average drawdown, which was calculated to be around 12 to 14%. So bear case says there could still be downside to 150 if macro environment flips. And then it goes down into further technical breakdown levels. Again, this is based off of information that I've plugged into it. So again, as I always say, when you're using AI, it's all about the information that you're plugging into it and just making sure that it is accurate information. So based off of that, the model determined that if 177 fails, next supports, well, we have the daily 200 EMA, which was at 161.22 we pointed out. And it talks about the 164.22, which is at the 61.8 fib, and 149.40, which is at the 50% fib. If those fail, recessionary drawdowns often tag the 38.2% level, which would be at 134.59. And so with that, the model shows a very low probability of a 20% drop, but it is not 0%. And so that then leads to a bear case price range between 135 to 165. And that's considering export restrictions, a recession, and delayed cap X for NVIDIA. So I think it's very important just being able to utilize that information, because this is not a live by die by situation, but it's a nice little framework where it can give you price ranges to look at, but then it also aids in your own research when you are drawing out your chart, when you are looking at certain support levels. It's like, okay, well, these are the price ranges that it gave for a bear case. I see the sentiment of the market and what's going on. It kind of, I feel like, in my personal opinion, it helps you gauge when you would want to enter a specific options call per se. And again, knowing that you have time on your side, you're increasing your probability. Nobody can really predict what's going to happen in the market. The best thing that you can do is at least increase your probability of being profitable. And I just feel that utilizing these Monte Carlo models, simulation models, can be definitely helpful on top of what we've been teaching you guys when it comes to the technical analysis, when it comes to different research tools and fundamentals to look at for these quality companies. So I definitely wanted to make sure I shared that company, because I know we only went over Visa yesterday, and I wanted to make sure that we covered that as well. And then also, I know that some people had questions in regards to when I showed ULearn. With ULearn, in terms of the prompts that I do for their earnings, I keep it fairly simple, at least in ULearn. And what I'm looking for is for it to highlight the pros and cons from the earnings report. ULearn specifically, I don't think you can really ask so many different questions outside of what you are actually inputting into the model, because it may tell you, oh, we don't have any information to, give an accurate output. So what you can then do, once you get the information you need from the earnings call or whatever report it is on that specific company, whether it's one of their main catalyst events outside of their earnings, you can then take that information and then plug it into like a Perplexity Pro, a Claude, or a Chat GPT, and then ask other questions that maybe it can utilize the web and give you more information on. Let me see. And I think, and then lastly, I think somebody had asked about like a checklist. I think, let me just pull this up. I did have some questions here that I think may be beneficial when it comes to deciding on when to enter an option. So the first question, I think, which makes most sense, would be, what is the probability that the company reaches my strike, right? And that, again, starts with checking out the historical drawdown. And the same way you saw me download the data from macrotrends.net and plugged it into the AI model, you can use that same data right there and simply ask the AI model, well, hey, can you calculate the average drawdown on this company? Because it's already given you the data over a 26-year time frame. And if you only want it over a 5-year time frame or over a 10-year time frame, you can edit it and adjust it as so. And then the next thing, you can use the Monte Carlo probability thesis, and then also consider your technical levels, as we just mentioned, support, resistance, where are we at when it comes to looking at that company. Next question, is there a catalyst within that time frame of however long you're going to be holding that contract, whether it's how many earnings are going to go by, and what is to be expected in those earnings. Fed meetings, what is expected from those Fed meetings, what is expected next month with the rate cuts. Jobs report are crucial, and seasonal market trends. I put that at the last part of that question to consider. And then, is implied volatility making the contract expensive? So if the implied volatility is high, your premium, if the implied volatility is high, the premium is inflated, right? So the trades require a strong move to be profitable. That's one thing to take into consideration. And typically contracts often deflate after the catalyst event, which is called an IV crush. So those are just a few questions I feel like makes sense to consider. when you're thinking about entering any options that you may be looking at. And so that's what I wanted to make sure I covered, that I didn't get to elaborate on yesterday as well. So that's what I got for you guys. I know it's getting late. I didn't want to keep going. But
there we go.
Yeah.
Another one in the books. I hope today was able to help you guys on a few different fronts. That's what we're here for. We're a community. We're here to help. We're here to serve. And we're also here together because we're all going through this together. Trust me, Dahoud, and Steph, we all go through the same emotions you guys all do when we open up our accounts and we see everything red or everything green. It's just normal human emotions, but we have to manage it the best that we can.
Yeah.
And then I also shared that document just now in EYLU, the investors group portion, the one where it was the institutional survey. I just put the link in there for you guys to use that as your homework for the weekend.
I'm going to also make sure I share the Mark Douglas classes. That's great homework for this weekend too. Just it will help you guys like start to form a strategy. What works for you, you know? Because like it's like everybody wants to know what to do when it's like panic mode, but the time to prepare is before that, having a plan before these moments come. So definitely check, I'll post that out. I think that's great homework for you guys too. Definitely check out that. It's about 6 different videos from that same Trading in the Zone, but the audiobook Trading in the Zone by Mark Douglas is on YouTube as well if you want to listen to the audiobook, but the classes where he teaches on this book are like top tier trader stuff you want to hear. So I'll share that too.
I'm gonna definitely tune into that this weekend.
Yeah, facts. But yeah, definitely, and we'll get this back up to you guys for the weekend. I know somebody had already asked, "Can y'all have this up on Monday?" We got you. We're gonna be on it and have that up for you guys, so you guys are prepped for the next week of the market. And I hope everybody has an amazing Thanksgiving week. Just wanted to give a quick shout out to Steph. Congratulations, Miss New Married Woman.
Thank you.
Shout out to you for that. I hope everything was amazing. I'm sure it was. I seen all the pictures. It looked beautiful.
Thank you so much. Yes, it was beautiful. Very cold, colder than it ever is in Jacksonville, but
minus the cold.
But it was
thank you everybody
for thank you.
Yeah, definitely. Thank you everybody for sticking around with us so late on a Friday night. We love y'all. We love what we do. We don't take it for granted. And like Austin said, we're here in the community. Don't hesitate to talk. We're all here to help each other out and grow.
Happy holidays, everyone. Enjoy the rest of your night.
Happy holidays. We'll see y'all back in December. Stay safe in this market, y'all. Alrighty. Bye-bye.